On the 3rd and 4th of May, my colleague John Butler at Fortune and Freedom published 2 articles about why inflation is back and how to invest to prepare for this inflation. And sure enough, about 10 days later, all hell broke loose when inflation data came in from the US, which showed inflation had jumped to 4.2% and producer price inflation had jumped to 6.2% for April. And this caused all sorts of havoc. And I thought it was time to get John Butler back on the videos to explain how he saw this coming and what he sees happening next. So John, why don't you remind us of what you said back in the beginning of May and how you managed to know what was coming back then?
Right. Well, I mean, there was actually a lot of evidence of pipeline inflation pressures building, and that evidence is it's over half a year old. And people were talking about it, that you saw broad-based strength in commodity prices, energy, industrial, non-industrial, including foodstuffs. Now, many people don't necessarily take commodity price inflation that seriously because they figure that by the time you get to finished consumer goods, it's just sort of noise, and it gets ironed out and smoothed out in sort of intermediate and final goods processes, flexibility of profit margins, and these things. And yes, in many situations, that might be the case. But I identified some things that were different this time around. The first of which was the entire policy reaction to the COVID scare from the prior year. As we went into the initial lockdowns, obviously governments were panicking to find ways to provide interim demand and income support as a result of many people not being able to work, in some cases not even part-time. And so they threw a lot of money at the problem on the fiscal side, and then the monetary authorities did what they felt they needed to do with interest rates and QE, et cetera, on the monetary side. And so all of this stimulus starts coming through to compensate for what is going to be sort of assumed to be weak demand. But the fact is that when you react that way to a natural supply shock, and let's assume that COVID is sort of a natural supply shock, it's just some exogenous event that causes disruptions. When you throw money at it, the problem is you don't really know where it's going to stick. You don't know where it's going to get traction. And you just know there's a lot of liquidity sloshing around out there. And this creates situations with bottlenecks in infrastructure, transportation, logistics, production of goods. And it gums up what was otherwise, say, a well understood, efficient, optimized, globalized manufacturing process or other process, be it processing of agricultural goods, et cetera. And I identified this as something to watch out for. So you have this mix of a negative supply shock on the one hand, lots of demand stimulus on the other hand, less supply, more demand. The only way to clear the market is with higher prices. And that was my thesis from over a year ago when COVID initially hit, and I saw the policy response. As Milton Friedman once said, there is nothing more permanent than a temporary government program. And the situation we're in now, of course, is that the authorities don't want to suddenly withdraw all that stimulus they threw at the problem. So the inflation pressure is coming through, and yet more stimulus is coming through. And so what we're seeing now is really just the beginning, in my opinion, of a sustained rise in inflation, not just a transient one, as some analysts and economic officials are now claiming.
I think that gives a really good overview of all of the things that I've written down to ask you about. But let's dig into the first one, which is this idea that it was commodities that sort of led people to worry about this in the first place. And the part of that I find interesting is that commodities are a global price. It's a globally set price that all nations are subject to. And that suggests that inflation is not just going to break out in some countries or very particular areas, as I would suggest happened in the past. But this time, the inflation is going to be very much globally felt, all at the same time. And that means the UK included is going to experience inflation. And I wonder whether that creates a new dynamic to historical situations where inflation has increased.
I think it does. And what we need to understand when talking specifically about the UK, or the US for that matter, these are countries that are huge net importers of everything. Of course, they're importing energy, especially the UK. Of course, they're importing food, especially the UK. All right. But yes, the US is, as we know, the world's largest net importer. The thing is this, over the past few decades, the US, the UK, and a handful of other developed economies have increasingly outsourced manufacturing for all manner of consumer goods to China, India, and other emerging markets. Yet in those countries, the fact is the average household is spending essentially all of its income on food, clothing, and shelter. They don't have the services, they don't have the luxuries, they don't have the broader range of discretionary consumer goods that we have in the UK, the US, and so on. But they're the ones manufacturing those goods. And the fact is, if your wages in those countries, your manufacturing wages, are going entirely to staple products, well then, as food price inflation goes up, guess what? You're going to demand higher wages, right? These economies don't have the same size of slack labor forces they did a generation ago. They are at closer to full employment. A lot of farm workers have migrated to the cities. They're the new global manufacturing base. And if they see their food bills going up, they'll demand higher wages. Wages to produce the consumer goods that we consume in the developed world. This transmission mechanism from emerging market food, clothing, shelter prices through to Western, developed, finished, luxury, as it were, in some cases, consumer goods. That transmission mechanism is very strong today, but it's a structural shift that many economists don't bother to look at. You know, economists like to look at things that are stable, predictable, econometric trends in the data. They don't like to think outside the box and look at changing structures in the global economy and wonder, maybe this is going to change what happens in future. I think it's happening now, and we're starting to see it showing up in prices.
It's an enormous reversal of a really long trend where globalization has led to falling prices for the things we consume. And suddenly that's going to reverse if the commodity prices increase.
That's exactly right. I agree with that. We've come to the end of this low-hanging fruit of taking very, very poor agricultural workers in many emerging markets, putting them into assembly lines where they can be more productive, manufacturing in the globalized economy. And look, don't get me wrong. I mean, this is a form of economic progress. But once all or a sizable portion of those poor agricultural workers have migrated to the cities and started working in the factories, you get into diminishing returns in terms of how much additional incremental economic manufacturing output you can get out of these people without paying them higher wages, especially in a context of higher food, clothing, and shelter prices when they're still not too far from a subsistence level of economic existence.
The other half of your prediction for inflation is all about the idea of a stimulus overdose, that governments are going to overdo their attempt to try and recover and to stimulate the economy after the lockdowns and the pandemic. And especially that's true in the US, where I think I read in the Telegraph that the size of the fiscal stimulus is vastly more than what's called the output gap, the fall in production and the increase in production that we can expect to have before inflation kicks in. And so the US is going to be the one that experiences this inflation first if the government stimulus does actually come through. And one of the interesting things about it is that it always takes a huge amount of time for fiscal stimulus to actually, hit dirt, to start digging things up. I remember the term was shovel ready back in 2008 and 2009. Right. Well, things aren't shovel ready now. It's taking some time. And so do you expect this Biden stimulus to really kick off just as inflation is kicking off too?
I think it will add fuel to the fire. Now, as you say, that fuel will not arrive all at once. And indeed, by the time his stimulus proposals work their way through the House and the Senate, he probably will not get all he's asking for. In fact, he may even get substantially less than he's asking for. But ask yourself this question. If he gets anything at all, given that the U.S. economy is opening up, given that global prices for all manner of commodities and manufacturing goods are already rising, then any fuel makes for a bigger fire. And so I think we should be concerned that this will be sustained. It may take us through the rest of this economic cycle. It could be that continually rising inflation is what ultimately, in a 1-2 years time, leads the Federal Reserve and other central banks to start tightening policy, and we head into another downturn. But sadly, that inflation may still be rolling through the system, as you say, because a lot of this stimulus will be arriving in the future, and you end up with a stagflationary mix at that point. Let's also keep in mind what's happening here. The public sector, that is stimulus, government jobs, etc., are taking a bigger share of the economic pie from the private sector. And many people believe that although the intentions are there, and the intentions are good perhaps, that the public sector just isn't as efficient in utilizing and allocating resources as the private sector. And so rates of productivity growth trend lower in that sort of environment. That's also a negative supply shock in the economic parlance, and you get into a stagflationary vicious circle, which could be comparable in many respects to the dreaded 1970s and early 1980s.
So you're not seeing this as a transitory phenomenon as the central bankers are. It's going to actually last. And we've discussed some of the forces for that, the commodities and the government overdose, as I call it. But what about just the simple idea that inflation has its own momentum? It affects expectations, and even a small spike, as we've already had, can be in and of itself what leads to an increase over time.
Exactly. As I've written before, inflation is not merely a monetary phenomenon, as Milton Friedman once said. It's also a psychological phenomenon. That is, if businesses begin to sense that their input prices are rising and may continue to rise, they will stockpile inputs into their inventory to try and stay ahead of it. Now, of course, that takes some inventory out of the market. So if one business does it, every other business has to sort of pay more to build their own inventory. These are non-linear effects that are affected by the psychology. And then on the consumer side, if consumers start to think, well, hold on, prices for things are starting to rise, I'm going to start front-loading certain purchases, especially for durable goods that might need to be replaced and that have a long lifespan. And they may even try stockpiling other items that they just think can, fill the larder, as it were, and help carry them through what might be a period of elevated prices. That also takes goods out of the market. The world of just-in-time inventory and just-in-time consumption, in theory, is very efficient, but it gets gummed up by this sort of behavior. And so as people start to smell the smoke of the inflationary fire and change their behavior, other people and other businesses see them changing their behavior, and they change theirs without even smelling the smoke. And then they all leave the theater, and you can have really large price spikes in very short periods of time. That's the inflation psychology. That's the danger. I think that's what's building now.
Something that I've learned from you, which has changed my thinking about inflation quite a bit, is the idea that it isn't actually the monetary side that drives inflation. It's actually the deficit, the government's fiscal deficit. And the reason for this is that money isn't just printed for no particular reason. It needs demand. There needs to be a reason for money printing. And that demand tends to be historically government deficits. The central banks need to finance the government deficits. And right now we have that already in spades because of the pandemic. We've got government deficits driven by the pandemic, and those deficits have to be financed somehow, which is why the central bankers are printing the money. Historically, that is what gets you hyperinflation. It is that combination. So are you expecting, thinking 3 or 4 steps ahead, for this inflation to continue to spiral out of control into really high levels because of that combination?
I think it's inevitable at this point. I think the timing is unclear, and I think the exact magnitude, of course, is unclear. But the general trend towards an elevated, sustained elevated rate of inflation that has not been seen for over a generation, I think it's baked in the cake at this point. I don't think there's any getting around it because, in a way, the fiscal authorities, as you say, they've kind of gone all in now, COVID gave everyone the excuse they needed to throw money at whatever they wanted. Indeed, if you look at Biden's stimulus proposals, which are still being sold under the guise of being COVID relief, I mean, 90% of it arguably has nothing to do with COVID relief. It's just basically handing out favors to the people that got you elected. I know that sounds cynical, but a lot of politics works that way. And I think you see evidence for it in that stimulus, in that proposed stimulus package. And I think that's true in other countries. There have been stories here in the UK about some of the sort of backroom cronyism that might have been associated with some of the COVID relief policies. Again, some of those are probably being investigated, I believe, because they look a bit dodgy. This is a fact of life. It's kind of a fact of government, but you're right. From a bigger picture economic point of view, if people are worried about the future, if people are concerned, they will save more. And if the government responds to that by borrowing more and spending more, you can still get your inflation, even if the private sector is worried and concerned about the future. And sure enough, that is sort of the combination that we're seeing now. Money is being spent into existence through government borrowing, and central banks don't seem concerned about inflation yet. I think we have a long way to go until the psychology changes the other way. In the 70s, it took a full decade. And it might take a full decade this time around.
One of the interesting things in your articles which warn people about inflation was the suggestion that gold is by far the best asset in order to prepare for what was coming, to prepare for the stagflationary environment, as you put it. Well, since the inflation spike has come out and inflation news articles have been all over the place, sure enough, the gold price has risen dramatically. So what do you make of what's going on in gold, and do you expect that to continue?
Well, gold did not really participate, gold and silver, precious metals did not really participate materially in the commodities rally that we saw as COVID lockdowns were easing, food prices and industrial commodity prices were rising very rapidly. Precious metals just sort of range traded and even drifted a bit lower until the recent recovery that you've pointed out. Now that may seem a bit curious, but as I've mentioned before in my writings, you also need, for gold and silver to really perform well, not only do you need rising inflation expectations, but you also need some risk aversion, because if people just expect rising inflation and recovery, they can also just go into the stock market and just keep chasing the trends in the stock market or other risky assets that offer a high yield or expected return. And as a result, I think precious metals struggled a bit. But now they've bounced, and they've bounced pretty strongly. You've seen a sell-off in tech as people get a bit concerned that while tech was a big beneficiary of the COVID period, that maybe that's over now, and maybe tech valuations aren't realistic for the world in which we inhabit, et cetera, et cetera. So precious metals are doing much, much better now that the stock market has been struggling a little bit more recently. So it's a much better environment for gold. But keep this in mind, that whole concept of stagflation, it's a combination of economic inefficiencies and public policies, including monetary, that throw stimulus at the economy nevertheless. So you're throwing stimulus into a less efficient economic mix. And so you get rising prices, you get pretty poor growth. Historically, that is the best environment for precious metals. They're both defensive, but they're also inflation hedges. So they kind of win on both counts. And sure enough, if you take a look at stock market performance during the stagflationary 70s and early 80s, I mean, precious metals win hands down. Depending on the sector, some industries' share prices still went up, but they struggled to keep pace with inflation itself. Very few sectors in the stock market strongly outperformed inflation itself during that period, whereas gold and silver outperformed very, very strongly because of the set of properties that they have vis-a-vis a stagflationary environment.
John Butler, thanks very much for joining us, and thanks for warning us about what's blown up all over the financial news.
My pleasure, Nick.